Right, and we are recording to the cloud. Yesterday, pretty good sell-off in the market, especially the Nasdaq. Looking at yesterday's closing prices here. Dow. Doesn't look that bad for the Dow, but when you take it into greater context, the fact that the index was up more than 320 points at its high, to finish down 0.01%. That's a pretty good intraday reversal there. S&P 500 down a little more than 0.5% or 21 points, and the Nasdaq took it on the chin with the Russell, both down more than 2% yesterday. End of quarter rebalancing, folks. We did see yields fall yesterday. This morning, still falling. Yesterday actually got below 1.60%. In the wee hours of the morning, like 3 a.m. and whatnot, 4 a.m. At one point they were positive, but they did finish the day slightly negative here today as well, which serves to figure. I mean, this is what we have anticipated, some equity weakness, some bond strength, bond prices go up, yields do the inverse, they go down. Oil backing up again after a really, and we said this yesterday, right? We said this doesn't look like anything more than a reflex bounce that we got in crude oil yesterday. After some, about 5 days worth of consolidation, you get that snapback rally. So far, it proves to be short-lived as we have crude down almost 3% and near the lows of the early hours here today. Gold not catching a bid, even though we'd still have futures under pressure. The whole, inflation protection hasn't played out this entire, reopening cycle. And, the forecasting for, really strong GDP growth. Again, that's the bigger factor here. Why own gold? Why own gold in this environment where we are, basically entering a new economic expansion cycle? What is the lure to gold if it's not even a inflation hedge, if you will? And, there's arguments being made that crypto is a better inflation hedge. It's a storage of wealth, right? Wealth protection. But, crypto's been down ever since it hit the highs. What was it? $62,000, $64,000 on Bitcoin. Under some pretty good pressure here today as well, down 6%. Most of our asset classes that we are looking at, commodities, yields, global equities, they're all pretty much under pressure here this morning. European markets at their lows. We're doing okay, up until about 6 o'clock, 7 o'clock maybe, on the DAX, on the Stock 600. I mean, the DAX was only down less than 0.2 of a point in that 6 to 7 o'clock hour. And now, and a lot of this could just be catching up to our price action from yesterday. Same thing in Asia overnight, as you can see there. A little bit of weakness there on the Hang Seng. Pretty good action or bounces, if you will, off the Nikkei and the Kospi. Australia, who cares? No, I'm only joking, but nonetheless, that's what we have in Asian markets overnight. Europe setting up for a rough session here today. And of course, our equity futures pretty much at their lows of the pre-market. VIX is up another 65 cents here. Nice bout of volatility over the final couple of hours of trading into the close yesterday. So again, this is what you expect, quarterly rebalancing. And by the way, futures were nicely open, higher in that 6 to 7 o'clock hour as well. And then things fell apart. As soon as 7 o'clock, and that's when most brokerages allow for pre-market trading, 7 o'clock, futures started to nosedive. We were up a good, 7, 8 points there on S&P 500 futures. We were up the exact opposite of what you're looking at right now in Nasdaq futures. So that's a 120-point reversal in Nasdaq futures, which again, when you're looking for a reason, knowing where we are in terms of seasonality, you can see it play out in price action. For every tick higher, we're being met with selling pressure. The markets are being met with selling pressure as pension funds, mutual funds are forced to rebalance in favor of bonds. It's no coincidence that as soon as brokerages are open, as soon as the market makers are in place, 7 o'clock this morning, the futures started to tumble. Futures were higher. Any tick higher is being met with selling pressure. That can only last for so long, of course, but again, just kind of understanding, the seasonality here and anticipating in order to tactically engage a market that is, under pressure. Fell below 13,000 there on the Nasdaq as of yesterday. Kind of go through some charts here, and I was looking because I want to see if we're oversold, right? When you have this game plan that we talk about daily here in the trading room, it is about monitoring when are the optimal times to layer positions. We started a couple positions yesterday. We can add to those positions here as the market continues to weaken and as we start to see more and more oversold conditions. And speaking of a rapid descent and oversold conditions, I think the Russell probably qualifies most in terms of the major averages at this point. Just about a 10% correction now from peak to trough in the Russell 2000 or small cap ETF, the IWM. Just about a 10% correction, and quite rapidly at that. Nonetheless, it's still up like 9-10% for the year to date. So that's how much outperformance the Russell or small caps have had here in 2021. 2021, still hard for me to say. But, looking at it here from Bespoke Investment Group, Russell 2000, last 12 months. We talked about this just yesterday, looking at this chart, but on the big boy chart, we looked at it and just what some of this needs to be worked off. Some of this hyperbolic, parabolic, if you will, move here is just getting worked off. Investors look for excuses to lock in profits. We think that there's probably no better time to do so when there is a greater contingency of the investor community that is going to be rebalancing in favor of bonds. So locking in profits, working off some of this excess here, if you will, dropping, if not slicing right through the 50-day moving average. Is that the end all and be all? If you slice through it? No, it's just a reference point. Moving averages are just reference points. And as long as they're still curled higher, as you can see here with the 50 and here with the 200, you're still in a bullish uptrend. As long as you're not making lower lows and lower highs, you're still in an uptrend. You start to get concerned when you're not just working off some of this here, but maybe we get down to that more local low back in January. That's when you start to say, okay, this is a little bit more than I had bargained for. You're going to need more information, of course. We'll see what the trend lines look like, later. But again, slice through the 50-day moving average, nearly a 10% correction. And this is after the Russell 2000 streaks above the 50-day moving average reached more than 90 days for the second time. And let's see, trading days in the last year, second streak. The other one, I guess, the longest, because there's been more days, clearly. 200 plus days above the 50-day moving average back here in, looks like 1983. And for those of you who know your market history, that the bottom of the market in 1982 through basically up to 1985 was a very bullish time period for the markets. So some good charts to kind of represent the frothiness that took place here in the Russell, and just how overbought or overextended the market, the Russell, the small caps have been. Need to expect some type of corrective action when you have that kind of persistence. This was pretty awesome, because everybody's talking, well, there's froth everywhere and the market can't just go up in a straight line. And most people are just considering a very narrow time frame. They're mainly considering, the bottom in March 2020 up to today, right? And we've rallied more than 75% from that March low. And people look at that number and they say, this market, has just gone up in a straight line. It's because of their time frame. If you add in just one more month, if you consider the preceding 13 months instead of 12 months, because we just anniversaried the March 2020 low, that's a year. But if you go back to February, which would be 13 months, over that period, the S&P 500 is up merely 17.2%. It's a big difference simply by adjusting your time frame from 12 months to 13 months. It is about the big picture. You got to think about the big picture. This is much to do about nothing. This, yeah. If you want to beat a bearish drum, go right ahead. Limit your perspective. Beat that bearish drum all you want. By the way, you've probably been beating it for the last 50% of this move. Big picture. Couple charts in speaking to the whole, oversold conditions. Looking at the Nasdaq Mcclellan Oscillator, right? It's a measure of advancers versus decliners. And as you can see here, again, this is the Nasdaq or the NAMO Mcclellan Oscillator Index. And as you can see, as of yesterday, March 24th, got down here to a -70. And we look at, on a daily basis, we're looking at advancers versus decliners, whether it's on the NYSE or on the Nasdaq or on the S&P 500. We're looking at it every day to see what the overall breadth is in the market. If your advanced decline lines are making new highs, as they have been doing religiously for the last 2 quarters, if you will, more than likely the indexes are also going to follow. As we say, breadth leads price. If breadth is making new all-time highs, advanced decline lines are making new all-time highs, eventually the indexes will also. The underlying breadth gives us, an idea of the confidence in the market, amongst the investors. So looking here at the NYMO, the Nasdaq Mcclellan Oscillator, which is an advanced decline line based metric, we can see what's been going on in the Nasdaq here lately, if not over the last week or so. We got down to -70 was the reading yesterday on NAMO. Can we go further? Clearly, yeah, we can. We can drop that much more. But again, we don't stay down here very long. We're pretty much right where we were at the end of February and before. We had a tradable bounce and then found a more local low there into March. But again, we didn't stay here very long either as we rose. What we can see is that we're making lower highs, right? We're making lower highs in the NAMO, which is not the best, feature here, technically speaking. But there are tradable bounces that you can identify. This is an oversold reading. In my opinion, this tells you, and remember, when we look at breadth, there's not much you can do with breadth when it's at the highs, except for, understand that high breadth readings, high advanced decline line readings, ultimately, will find corrective waves. The more actionable breadth readings come when you see oversold conditions. Because again, we are in a long-term uptrend. We are in a new economic expansion cycle. We do have, forecasting for earnings growth in 2021. Put all that together, usually these oversold conditions resolve with, upside. In terms of a tactical approach, yes, this is where you should be buying. It does not mean this cannot go down further. It just means you are in the buy zone. This ultimately will find a tradable bounce. How high, I don't know. Couldn't tell you. That's, not my greatest consideration. It is just about recognizing that we are in oversold levels and at a, in a buy zone. We can look at the same thing for NYMO, or the New York Stock Exchange Mcclellan Oscillator, which also yesterday found its way into the buy zone. As you can see with this one, the New York Stock Exchange Mcclellan Oscillator is now in the buy zone. Dropped from the high 40s to the low 50s. So, we have a sub 50 reading, you are in the buy zone. Many times this is about it. We're in the area where this is just about, washed out. Again, can it go lower? Absolutely, but we don't stay down here for very long. We don't stay down here for very long. We have pretty substantial spikes. Just like the NAMO, the Nasdaq Mcclellan Oscillator, this one has a series of lower highs also. It's something to recognize, but again, it's not the end all and be all when it comes to, a bullish trend. More than likely, these will eventually resolve, absent an exogenous event, of course, which we can't forecast, absent a black swan. More often than not, these are going to resolve to the upside. So the Nasdaq Mcclellan Oscillator, the New York Stock Exchange Mcclellan Oscillator, both advanced decline line readings, breadth readings, are in oversold buy zones, if you will. But it's about being tactical, having a game plan. What are you buying? How much are you buying when we are at these levels? How much pain are you willing to take as an investor should we find, ourselves going even deeper into oversold conditions? Those are the questions to ask yourself and plan accordingly, of course. All right, it is Thursday. What do we get every Thursday besides jobless claims that just came out, I think, a minute ago? Let's see. Yep, jobless claims Thursday. All right, well, 684. Nice, right? Well, this is what we were looking for, a big drop after a not such a good number in the week before where we saw a rise, a significant rise at that, missed expectations. This is a pretty decent drop, below 700,000 on initial jobless claims. Nice drop below 4 million as well on continuing claims here. Good stuff. Is the market reacting? Again, we are not. Most of the economic data, as we've said, day after day, pretty much month after month, given the amount of fiscal relief that has been passed and implemented, most of the economic data is not going to be market moving. And for different periods of time, as we edge closer to a full economic reopening, very, very few economic data points will prove more relevant for that period versus other periods. And as we get closer to the full reopening, right now we're in this period where we have rising rates, we have higher yields, and that's the data associated with reflation / inflation. Those are the more market moving metrics that we're going to, see for this particular period. In the past, it may have been retail sales. Before that, it may have been non-farm payrolls. But now it's going to be data points like CPI, PPI, and due out tomorrow, personal income and consumer spending, or the Fed's gauge of inflation, which is the PCE, and the core inflation rate. That comes out tomorrow. It could prove market moving. We'll see. Oops. Jobless claims right now. Again, not affecting the market. To be expected, right? As we get more inoculations, and as we are seeing job openings just start, we're seeing it on the Indeed website. They're soaring. So we have more people getting back to work. This is just to be expected, not going to be market moving. Nonetheless, for the big picture, that at 30,000 foot level, this is what we want to see. Fewer initial jobless claims, fewer continuing claims, fewer PPU claims, so on and so forth. So good data point here. You guys have any questions? Put in the chat box. Holla. First under 700, yes. Finally, right? Yeah. Good morning, humans. Good stuff. Some data that goes under the radar as well. Oh, I forgot, actually. Let's get back to the I don't care data point of the week and this useless stuff. Like AAII Investor Sentiment Survey comes out every Thursday. We see a nice little bit of a jump from the prior week in terms of bullish sentiment from 48.9 to 50.9. Drop in the bearish sentiment over here. We're still nicely above, in fact, well above the historical average for bullish sentiment. Serves to figure we moved to the downside here this week, right? And people will tell you left, right, front, and center that these are to be used as contrarian indicators. But keep in mind, we spent months during the bull market, the start of a new cyclical bull market within a longer secular bull market that started in 2013, depending on who you ask. But we spent quarters actually uptrending in the market with the bullish percentage remaining below the historical average. We've only been above the historical average maybe for the last 3 months, 4 months. We spent a goodly amount of time below the historical average and above the historical average for bearish sentiment. So contrarian indicator, yeah, that didn't quite work out if you positioned yourself using this as a contrarian indicator. So be careful with those kind of things. All right, weekly jobless claims to the lowest level in more than a year. Awesome, good stuff. Get back to work, humans. European equities now haven't budged much, still down about 1% there on the DAX. Bonds, have they changed? Nope, they've been down pretty much, about 7 o'clock also. So as we saw equity futures sell off, we saw bonds start to move higher and yields moving lower. Are we going to drop below 1.60? Well, somebody does have a call out there saying that he actually expects the 10-year to drop down to about 1.47% before it starts to ratchet higher once again. And we've been talking about this basically since last week. Last week we said we're in a topping phase when it comes to the 10-year yield. We're in a topping phase. We don't know what the ultimate or the interim top is going to be, but we have all the trappings so far as momentum, divergences that we identified in the TLT and the TNX. The ticker symbol for the 10-year yield is the TNX. The ticker symbol for the bond ETF being the TLT. And we saw breadth divergences there, bearish breadth divergences, which tend to, identify a topping pattern is, taking place. And since then we have, found lower yields from 1.754 down to, and we did briefly break below 1.60% just yesterday. So we'll see. Oil here, again, still down nicely. Gold getting no benefits. And crypto keeps falling here. This is a pretty decent decline here in Bitcoin today, or, the last week, I would say. And the dollar has been up all morning once again. So as equities are, consolidating here on a week over week basis, and from last week's all-time high, we are seeing a flight to the dollar. They're not going into gold. They're not going into Bitcoin. They're not going into commodities. It really is the only place they're going. And of course, bonds due to the rebalancing that we're seeing. So we'll see when the risk on appetite, because these are all the trappings of a risk off, asset class, broad asset class performance. We're seeing risk off. When the risk on appetite returns remains to be seen. And that's why we keep monitoring for oversold conditions. In the way of other breadth indicators, how fast has the descent been in the Nasdaq? Well, we're getting close to oversold, rapidly oversold conditions once again in the Nasdaq. Keeping in mind, we've checked out this before. We've outlined the percentage of Nasdaq 100 stocks above their 10-day moving average. And typically when we get down to these levels, you get a very sharp bounce. The good news in this one, while we were seeing lower highs in our NAMO index, this one actually made higher highs, or the highest level since last November. Again, different breadth for different folks. But this one is not oversold. This one is saying we could still see some more downside pressure. Right now, only 31% of NASDAQ 100 stocks are trading above their 10-day moving average. And when you get up to these, you're not going to stay up here very long either. These are very frothy levels. These are your washout levels. It's easy to buy at washout levels. And that's why I say when breadth is strong, it's hard to pull the trigger up here because you're only going to stay up here for so long. It's easier to act upon oversold conditions. In terms of trading above their 50-day moving average as of yesterday's close, once again, we've tried and we got above 50% of stocks trading above their 50-day moving average, but we couldn't hold, which serves to figure that we also couldn't hold the 50-day moving average in the Nasdaq itself. We got above the 50-day moving average briefly and the sellers came, fell back below. So the percentage of stocks trading above their 50-day moving average in the Nasdaq, only 36% now. Again, this is actually in oversold territory, but we could fall further. We don't stay down here very long. But you can see just continuation. And this, basically, verifies, if you will, the downtrend that has taken place in the Nasdaq since peaking, here in mid-February, basically. We are not in a long-term downtrend, don't get me wrong, but right now we're in consolidation. We're still in this consolidation period for the Nasdaq. And we're about to touch the 100-day moving average here. 100-day moving average in the Nasdaq comes in at 12,826. Looks extremely achievable, right? It also has been support, as you can see. That 100-day moving average has proven support here recently. The head and shoulders, failed head and shoulders pattern, if you will. 12,700, Bank of America Global Research says 12,700 is also another level of potential support before we get to, or when, after we get to, I should say, the 100-day moving average. And that would be this, momentary trough right there on 3-4. just before the February non-farm payroll data came out on 3/5. So we'll see how this plays out today here. In terms of volume, if we just look down here, when we were making these lower levels, volume was actually higher. So we'll see. And what we saw yesterday in the way of, if we think of just technology, the equal weight technology sector ETF actually did pretty well. The cap weighted technology ETF, XLK, was under pretty good pressure though. Again, more data came out recently. This is looking at truck tonnage from February. Didn't get a lot of attention, never really gets a lot of attention. We should get the March one pretty soon here as well, in the next couple of days possibly. But you can see truck tonnage did fall, and a lot of this is weather related. February's drop was exacerbated, perhaps completely caused by the severe winter weather that impacted much of the country during the month. And, we looked at existing home sales and saw pretty much the same impact. A lot of severe weather, and of course, Texas was a big problem. Did we get the final GDP also? Final GDP today, I believe. Anybody? Hi, Seth. Can you send a link with the charts on the Russell? Oh, yeah, sure. No problem. I will. I'll send you email. No problem. Sorry, Mark. I should have checked the inbox here, but yeah, absolutely. Apple 118.90s. Okay, good. We have a trade alert out there. You lied to me. Now it's back up. I know that was in the chat box already, and I just checked. So, but yeah, we have a trade alert out there on the day, not the pre-market, on the day for Apple. As I said yesterday, if it gets back into the 1-teens, if you're thinking long term, this is where you should be buying Apple. Again, nothing's really changed in Apple except for the price over the last couple of months. Apple didn't all of a sudden go from 145 to the 120, teens, if you will, because their business is falling apart. These are opportunities, consolidation, lower prices. These are opportunities. It's scary, I get it. In determining when should you buy, Walter Deemer's book, Doug Cass's quote, which made the title for Walter Deemer's book, is, when it's time to buy, you won't want to. When it's time to buy, you won't want to because of the fear, because of the price action. If there's ever a time to be contrarian when it comes to practical purposes, it's that. It's when you are scared. That's telling you that you should buy. It's those emotions that, we tend to let build and paralyze us from taking the appropriate action. So, when it's time to buy, if you feel like you don't want to, that's probably the time that you should. That's probably the time that you should be buying. As they say, Warren Buffett, when there's blood in the streets. So we'll see what happens here today, but futures are not improving. We know that. We can see that. Futures are not improving here. Dow futures are down 151 here. And the VIX is now up 71 cents. We got 660 here on UVXY. We got our first position on the board in that yesterday as well again. And we'll be looking to build at least 2 more positions depending on price action. And of course, ensuring that we are taking a full scope of the macro market thesis day in and day out in case we need to adjust our expectations. As of right now, I don't see anything out there in the macro market that is forcing us to adjust our thesis. The game plan is what it is. We're looking for 2 more positions on UVXY. We'll also be looking for 2 more positions on TQQQ. as prices are getting cheaper here today, once again, with the Nasdaq under pressure. Semiconductors have been weak. They're under pressure again here today. And what we've noticed is that if software's not working, if semis aren't working, the Nasdaq's not working either. Under 400 once again here in semis, which I did not think was going to happen. I thought there would be, you know, a wall, a barrier of sorts there where, you know, the dip buyers, the value seekers would step in. And usually when I'm wrong, it's because there's a market operation going on that just can't be beat. That tends to be, you know, the overriding force, that market operation of quarterly rebalancing. And just knowing that's what's happening here should give you that much more confidence in executing your game plan. Like, this isn't about fears over the economy. This isn't even about fears over COVID and the variants and things of that nature. This is a market operation that needs to just, you know, wind down. Quarterly rebalancing. This has been happening all week long. This will continue into next week. 3 more trading days to go next week until we actually hit quarter end and start April. All right, we came into this week at 39.13. Yeah, again, this is not a big down move here that we're seeing on a weekly basis in the S&P 500 at 38. We'll call it 90 for round number sake. We're only down 23 points on the week. We were down 0.75% in the previous week. To be expected consolidation. Couple calls out there are not looking very good though right now, like JP Morgan's 4,000 in Q1. That's not looking very good. Some of our studies are not looking very probable now. It can still happen, but you know, here we are on the 25th, 10 days after we had 5 up days in a row in the S&P 500. And historically, when that happens, 10 days later, the market is higher 81% of the time. 10 days later, market is higher 81% of the time. 10 days earlier, we were at 39.68. That's going to be a problem. So, you know, unless we have just a extremely robust recovery and buying spree here today, this is going to be the second time in a row, in fact, that this signal, this study of 5 consecutive days after also closing above the 50-day high, that this is going to fail. It happened in February also. We kicked off February, 5 trading days in a row, kicking off February, we were higher. 10 days later, the market was lower. It just didn't work that time. It didn't work this time. This average is going to go down, obviously. Sometimes the probabilities don't work out. This is just one study, folks. Just one study, though. This one is panning out, though. Where is it? Nope, let me back up. The TLT study is panning out. This one here. Back half of March is working. The TLT, 20-year bond treasury ETF, usually sees into the end of the quarter, the end of March. These are all, you know, days in March historically. You do see the TLT higher. So that is so far working out. Many data points, as you can see, and it was up yesterday on the 24th. So trucking down there, but that's just one shipping index, if you will. There's many shipping indexes. There's the Cass Freight, there's the Harper shipping index, and there's the Baltic Dry shipping index. And as you can see here, we are at very healthy levels on the Baltic Dry Index, folks. Very healthy. We can look at the 1 year. You can see still, look at the 5 year. Extremely high. This is to be expected also. We know this is, I mean, once you shut down a global economy, you're going to have, extremely, rapid advances off of very low base comps, if you will. This also feeds into the inflation narrative, because part of the Baltics Dry Index is calculating shipping prices. So it's not just volume being shipped, it's also prices. But again, very high levels here. What's going on in the market, the financial markets, is not a matter of the economy. Economy is doing just fine. Get to a couple videos here. We're almost at the top of the hour. What did I want to real quickly here? Just a couple of my tweets from this morning. And speaking of inflation, right? Like, why we have these conversations about inflation is just what I think what the reality is. If you're looking for inflation, it's probably in spare time. People have too much time on their hands. That's what's been inflated more so than anything else. Most of what we see is just reflation and or extremely low comps, from last year that we're going to anniversary. And when those drop off, then we've got, more realistic and truer picture of CPI, PPI, and the PCE. But right now, we're still dealing with extremely low comps from, when we essentially hit the pandemic period and the trough in the financial markets, in the major averages. Draw your trend lines here, folks. This is basically the CPI going all the way back to 1990. Draw your trend lines. Why do we talk about inflation? You can get momentary bouts of reflation, but they almost always revert and deflate. Draw your trend lines. And we tried here in 2018, right? Lower corporate taxes, lower income tax rate, tariffs. We could only hold that for so long before we dropped. That was that's an effort here. Extremely bullish market in 2017 will also lend itself to higher consumer prices. To keep that going, you got to put those tariffs in place. You got to cut taxes, really start to heat up this engine in the economy. But again, there's only so much of that can last. Prices revert. The consumer says enough's enough. It's just a natural thing in the economy. It doesn't matter the Fed does this, that, and the other. They'll fuel it one way or the other, but we're already pointed in one direction long term. Draw your trend line. So why we talk about, again, I think there's just too much. There's inflation in spare time, in my opinion. Going back to, this is a tweet I put out there yesterday. This is Bank of America Global Research. Nasdaq, big support at 12,700. They draw the trend line right over here. It's basically the neckline of the head and shoulders pattern. The old adage says that there is nothing more bullish than a failed head and shoulders top. Holding support at 12,758 to 12,700 would keep this bullish failed top pattern intact with upside potential to chart and downside gap resistance at 13,312 to 13,564. And then to the mid-February peak at 13,880. Should support give way, the pattern for the Nasdaq would weaken with risk back to the early March low of 12,208, which again, you have to consider in your game plan. This is part of, evaluating and structuring your dip buying activity. And should you be buying the dip? Yes. In my opinion, yes. Nothing has changed in the way of earnings growth potential. Nothing has changed in the way of high yield credit spreads. That tells us there's something wrong in the credit markets. We still have this tightening in the credit market, high yield credit spreads. we get up to the 5s and 6s, you hit the pause button. Something is upsetting the credit markets at that point. But right now, not at all. Do we have an inverted yield curve? That would be another measure that says you hit the pause button. No. 148 basis points. We got up to 158 basis points. Flatten the yield curve as we see the 10-year yield coming back down. A good 15 basis points since hitting its highs last week. So we have a very steep yield curve if we go back 5 years. This is the steepest yield curve we've had since 2015. Buy the dip. Until we see some of these indicators fail or prove to just give us the cause to pause, you continue to execute your game plan. I know it's not easy. Seeing lower prices day after day, seeing the breadth indicators show weakness. But again, that's what you want. You want to be buying low. You want to be selling high. It seems to be that, that works when we're shopping for things, when we go to Macy's for the store-wide 25% off sale. When it comes to, our capital, our investing dollars, psychology kind of works backwards because there's that fear element that, is correlated to actually losing the capital. But, when it comes down to it, you can't time these things, but you can plan. And if you take the emotion out of it and just execute the plan, you'll find out that over the long term, it's not about timing the market. It's about having a plan that keeps you in the market, not about timing the market. It's time in the market. We can coming back a little bit there on futures, but yeah. And, this looks at all the corrections that we've had since 1980, all the double-digit corrections that we've had since 1980, folks. 1 year later, after all these double-digit corrections, this was the lowest one at 10%. Qualifier, right? Double-digit corrections. Lowest one at 10%. A year later, up almost 40%. Again, this is just a perfect chart or table that establishes and validates buying the dip, staying in the market, keeping your equity exposure. Very rarely do we have consecutive down years. Here in 2000, we did. Here in 2001, 2002, 2007, yeah, which led into 2008, the financial crisis. But they're very rare. Just something to take stock of, as they say. All right, well, let's see. Do want to check out our first video of the day before the market opens. Guests, we always look at David Keller's The Final Bar, see who he has on as a guest, if they have any relevant commentary with respect to what just happened in the market and what they're looking at. His guest last night on the show was Samantha LeDuc. We'll get further into her in a bit.
Email. Also, you can go to all the app stores, search for Stock Charts TV on demand. I want to welcome on my guest, Samantha LeDuc. Samantha is a frequent guest on The Final Bar, always brings a good big picture perspective to help us make sense in uncertain times. Samantha, welcome back to the show.
Hey, thanks so much. I'm really glad to be back because we get to kind of do this quarterly review of last calls, and this is timely. We get to revisit one.
There's a lot happening right now, and certainly feels rotational overall. We're starting with growth versus value. Give us a sense of how you're seeing things right now.
Okay, well, first I got to go backwards before I go forwards. The last time I did this final bar with you actually was August 20th. And it was right after I had made a call with clients, and I had also.
Wow. Can we make sure that we pat ourselves on the back here, folks? I mean, can we really not highlight our own attributes in former calls? But go ahead.
On a public post, which was I short gold and bonds. And the theme was, and this was basically beginning of August, that it was time for bonds, bond bubble, if you will, some of the frost to come out, gold to come down. And since then, they are obviously, gold really corrected more in time than price, but bonds had their biggest peak to trough sell-off ever. So, and it's still not done. Right now, what we're having, I believe, is a bond bounce, which is very much because of end of month quarterly rebalancing by pension funds, which also, by the way, is a decade big rebalancing. So out of equities and into bonds. So I fully expect a bond bounce, which we're getting, but then watch out come April. So I do not think the bond lows are in. I'm talking specifically TLT as an example, but this was also a theme that I revisited when I was graciously invited back first of the year for the 2021 Stock Charts TV predictions. And my number one theme was small caps over medium, medium over large. And all this growth to value chart really emphasizes is that rotation from growth into value, meaning that value would outperform growth, that large cap would stall. And it really did. September 4th was the top. And if you look at a lot of the big tech plays, you'll see a lot of sideways for the past 6 months, while small caps have been hot fire flames, right? Not just the, Biden bid into the election, the blue wave, all the stimulus expectation, not to mention the Pfizer vaccine announcement November 9th, and then energy just took off strongly November through, and then especially January, February, that has now led. So last year, energy was the laggard, right? The bottom of the pile as it relates to sectors with poorest return, and tech was, of course, number one. This year, it's energy. So they have risen, and now we're in digestion period the past month, obviously post FOMC, when we have this rotation, I believe, quarter end with rebalancing. We have a definite change of sentiment as it relates to the growth plays. They are in trouble, those who are holding the growth plays. Are they going to recover? Are they taking profits in advance of, capital gains and harvesting, if you will, before tax deadline, or fear of increased taxes? But long story short, the theme that I had last August when we talked, that bonds would go down with gold, and this growth to value rotation would kick in, which means value would outperform growth, has absolutely transpired. And then the first of the year with the predictions, they were going to be very strong. They have been. Now I look at this bottom panel where it's yellow highlighted. This is an indicator, but it's basically telling me it's not done. And the mountain, if you look where the yellow arrow is pointing down, this is a very large mountain to climb down. So I think this is still going to outperform. Growth over versus value is going to be challenged. I think it's going to have a.
That was a pretty big drop here in 2013. This was a protracted drop, and a big drop here into 2000 and end of year 2016. Seems like growth doesn't really have a problem recovering, though. Seems like growth doesn't have a problem recovering, though, and having extended periods of outperformance. So essentially, this time has to be different.
A tough time.
So as you think, Samantha, about this, the coming months, and, obviously a lot of these names have had exceptional runs, right? Energy stocks have rallied beautifully. Banks, regional banks have done incredibly well on rising rates. So the movement that we're seeing in, this week, where we're seeing the rotation lower, we're seeing things be under pressure. This, to you, am I right in saying this is more of a short-term rotation of sorts, and then it's back to value over growth, and continue to lean into those value areas, things like financials, industrials, or how would you think of it differently?
So financials, I'm a little bit more suspect of, I will tell you right now, industrials and boring old tech, and definitely I think energy will have a resurgence, especially going into the summer months. We're going to continue to have rising CPI. You know, May's report for April will show strength. June's report for May will show strength. So I still think the energy sector is going to perform, again, relatively outperform a lot of the growth stuff. And I think a lot of new traders who came in last year don't realize is that their high-flying ARC, components, or ARC ETF itself is a duration trade. And as the long end has continued to rise yields, and you can show that next chart, it isn't just higher yields, but take a look at that rate of change. If you put your green circle around that yellow arrow, that's a 100% rate of change increase. This has never happened in the history of the 20-year. I can show you the same thing with the 5-year, and look at the head and shoulders underneath, which I was showing clients last year, saying, "Ooh, we're in trouble. This is a new interest rate regime." So with that, tech is a duration trade, and they don't understand that. So I would definitely
Right. The whole of the investor community doesn't understand that tech is a duration trade. Okay. The whole of the, okay. And the chart before that we looked at for years and extended periods doesn't understand. Okay.
err on the side of value investing. There will always be select stock picking within the tech space, but you can see what's happened with the SPACs, and I think Bitcoin right now is also going to have some issues with a rising dollar, and I think treasuries are having a tough time fighting this inflation, so it's going to now be the baton passed over to a rising dollar to help fight inflation. But we have it. We have inflation. We're going to have higher yields, and that relative strength with value, although the easy money has been made, I still see it as outperforming growth.
Samantha, we'll have to leave it there. It's such a great perspective. Appreciate you sharing.
All right, good stuff. And it is good perspective. Don't get me wrong. It's just a matter of her perspective, right? All these folks that come on the final bar, all these CMTs, all the strategists we see on CNBC, all the analysts and reports that we get, we disseminate, we look at, all the videos that we watch day in and day out. Guess what? Everybody has an opinion. That's it. They're all opinions. And they're all based on, experiences and abilities. And everybody has a different ability when it comes to examining the data that's before them. Some people have a bias that they just can't get over. Others, they're as objective can be. Either way, most are just giving their opinions. I know Samantha. Finom Group used to have a relationship with her firm. This was one of the articles that she wrote back in 2019. Back on October 2nd, I suggested to clients that markets would run up into October 31st and to target the S&P 500 around 3060, blah, blah, blah. I consider current price action, again, this is 2019. I consider current price action around this level to be cruising altitude before it gets a little bumpy again. But in the prediction and investment game, we can be right, but have the timing wrong. She was basically at this time calling for the market to go lower, I believe, or maybe continue to look at bonds and gold, US data. I suspect bonds about to roll over, structurally force yields to pop, then oil spikes with reflation trades. Here it is. Should a trade deal, and we all remember the angst in December over will we not have a trade deal? Will we raise tariffs that much more? Should a trade deal of any substance not materialize and a recession triggers instead, the safety trade into dollar will further hurt companies, which in turn will contribute to an equity and bond sell-off, likely confirming the end of the 10-year bull run. Again, that was her call to clients back in November 2019. What did the market do? Of course, it's the benefit of charts. You can always go back in time. We'll do the 2-year chart here. And as you can see, you know, we just continued to melt up here. This was June 2019, another one of her articles. This isn't 1995. Stock market will be sorely disappointed by a Fed rate cut. Did the Fed cut rates? Indeed, they did. They cut rates 3 times in 2019. Cut rates 3 times by 1/4 basis point each time. June 2019. Let's see what the market did. Here's June. Market melted up through basically all of July. Had some consolidation here, and of course, market continued to go higher. Markets will be sorely disappointed. Get off my screen. Despite the Fed's support, this stock market is headed lower. At the beginning of November 2019, 2 calls, same year, both bearish. Market did nothing but melt higher through 2019 into the new year, and then COVID. Now, if she had forecasted COVID, awesome. Awesome, thank you. Good stuff. But of course, that was not the forecast. Like I said, we had a client relationship with Samantha back in 2019, for which she licensed our materials at Finom Group, our research reports. But then those articles started proliferating. I'm like, and you guys have read in my articles, you know, I'm long-term bullish. I'm not about trying to time, you know, potential downturns in the market, because I know how those downturns are going to resolve themselves. So when I see that, you know, basically our materials are just generating various bearish theses and not really benefiting the average investor, I pull the plug. I pull the plug. Like, you're not going to use my works for those purposes. There you have it. Moving on. Point being, everybody has an opinion. These folks that you come and you see on CNBC day in and day out, they're no better than you and me. They're not, especially if they are giving you any kind of near-term forecast, bullish or bearish. I don't care that somebody's bearish near-term any more than I care if they're bullish near-term, because I don't care about the near-term. Position locally when you get better prices, but position locally for the long-term benefit. Get it? Got it? As they say, good. All right, Bitcoin off of the lows, back above 51,000, but still pretty sharp downturn again here today for Bitcoin. Little bounce here across Europe. Stock 600 up, down 0.75%. The DAX down a full percent almost. Bond yields at their lows. Again, out of equities into bond. Bond prices go up. Yields go down. To be expected here during the quarter-end rebalancing. Oil, even lower. Down $2 a barrel there. Gold, is it a safe haven? It surely isn't today. It wasn't yesterday. Copper, silver, precious metals, industrial metals, all down here today. Again, crypto. The only safe haven right now that we're seeing, or safe havens, are those bonds and the dollar. But even the dollar has cut its gains in half. How will this market open? It looks bearish based on futures. Will this hold any more than we've seen in the past, where we've had equity futures nicely higher and then we've given up that through the first hour or 2 hours of trading? So what we see right here in futures is not to be taken as the be all and end all for the open hour session or trading day, if you will. Nonetheless, we looked at some oversold conditions by way of the Nasdaq, Mcclellan oscillator, the NYSE oscillator as well. This is where, when you have cheaper prices, yet we don't have a change in our macro market thesis, this is where you employ your game plan to buy the dips. Until that changes, well, and for all of the, focus on Nasdaq, focus on tech, using the 1998 to 2000 analog, which we have been mirroring very well, we're right where we should be with the Nasdaq. Is this chart negating what Samantha LeDuc's chart so far as value outperforming growth? Is it negating it? Could be. Which chart's better? Who cares? You don't know. All we do know is that history's repeating. So like I said before when I interrupted the video, Samantha's chart basically, and her verbiage, suggests that this time has to be different. Yet, what we've seen from the post-pandemic cycle is basically a repeat of human behavior. Maybe that's the answer to my previous question, which chart's better? Take it one day at a time. We don't know if this will go off the rails and be down here while we drifted higher 1999 into 2000. We don't. But for now, this is the roadmap. This is what we anticipate. But as always, be flexible and open-minded to a wide variety of outcomes. Any questions? Put it in the chat box, humans. All right, will do. Already covered double bottom FNGU. Good morning, everyone. Good morning, Aaron. Lots of bargains. That it is indeed. Apple, with a couple minutes here, we could get executed on that Apple when the market opens, which I would be grateful for. Up 79 cents there now in the VIX. Looking at VIX futures. Let's check that out real quickly, see what term structure looks like. We've lost some contango. We were 9+% yesterday. We're 7+% on the front month contango right now. Roll yield has also come back in some from 20. So we got about $1.20 for round number sake in terms of roll yield. Roll yield, again, is the difference in value from that front month future contract to the VIX price itself. Just subtract. You get your roll yield. The wider your roll yield, the better it is for a duration short. A long, give yourself at least the duration of the VIX futures contract. Right now, we got 26 calendar days left, not trading days, but calendar days left here in the April futures contract. So we'll see what happens. This will change every minute of every hour of every day of every week, of course. But right now, it still does favor a short volatility trade. Just make sure you give yourself duration. How do you give yourself duration? Limit the position size. A, be willing to hold and add at higher levels. We don't know that the VIX will or won't go up to 25, 30, any more than we know whether or not it'll go down to 18s again. 17s. We shall see. All right, with that, end the recording.